Recording in progress.
Hello, Ed Yardeni. It's March 20th, 2023. How time flies when you're having fun. And maybe we're not having fun here in the markets, but you got to say there's never a dull moment in these markets. Past week or so, we've had this banking crisis issue. It's nice that this morning we see that one of the major issues on a global basis, the Credit Suisse issue, seems to have been resolved. I think there's still some concern over there about their banking system, but here at home, we're seeing that the regional bank stocks are doing somewhat better. I pointed out in recent QuickTakes that there's evidence that some of the insiders have been buying their own shares in the regional banks. If anybody should know that there's value there, it would be them. So the insider buying is somewhat encouraging. So is the fact that the Fed came in and basically guaranteed 100% of all deposits held by 100% of all depositors. I know there's all kinds of moral issues about the Fed doing this and the kind of risk that it creates in the system. But for the here and now, I think it certainly has diminish the likelihood of continuation of bank runs. And right now, it just looks as though the ones that have made the headlines are the ones that are being sorted out. And so far, knock on wood, we haven't seen a contagion effect with more. Unfortunately, or maybe, you know, the reality is that we all lived through the great financial crisis. And we all know what that was like, where, you know, one domino fell, knocking down the next and the next and the next. And it took quite a while for the whole financial system to basically implode. And it was a long, brutal bear market. And so there is a sense of deja vu all over again. Are we really having a banking crisis again? And the answer is yes. The question is, how severe will it be? There's no way it's going to be as severe as the GFC, the Great Financial Crisis. But there's still a chance that it may not be as cataclysmic an event as some of the perma bears are growling right now. They're dancing up a storm here in terms of telling us that they were right about how you can't raise interest rates by almost 500 basis points after having free money without breaking some things. So a few things have broken here. The question is, does it then lead to a credit crunch? Which then leads to a recession. And along the way, the bear market comes viciously back. I still think that we made a low on October 12th in the S&P 500. I still think we made a top in the 10-year bond yield at 4.25% on October 24th. I will say that the yield curve gets credit for anticipating a financial crisis. But it's too early to say for sure that this financial crisis becomes a credit crunch, which then becomes a recession. And let's not forget, interest rates are coming down here. We've seen the 2-year and the 10-year come down dramatically. It's very likely that the Fed is getting awfully close to terminal on its Fed funds rate. My advice to them is there's every good reason to tell us that there's no reason to raise the Fed funds rate by 25 or 50 basis points at the next meeting. There's certainly no reason to do 50 basis points. 25, is that just an indication that you know, they think that things are stable enough they can do it? I guess their concern would be if they don't do 25, that might raise fears that they know that things are going to get even tougher. So I'm not quite sure how they're going to play it out, but I think they're just about at terminal, maybe let's call it 5%. And once again, the yield curve seems to have called out pretty well. The yield curve tends to invert pretty close to the tail end of monetary tightening cycles. Now, the yield curve has been inverted since the summer of last year, so it's been telling us for quite some time that trouble is coming. And I think the trouble has come in terms of financial crisis. But let's look at some of the issues here related to the credit crunch. Let's go to some charts. Oh, I think I finally mastered how to do this without screwing it up. So I hope you're seeing the charts. If not, you can always email me. Okay, so here's a chart I've shown many times in recent weeks. This is the U.S. yield curve and financial crises. You can see that the yield curve tends to invert during periods of monetary tightening, which is the red shaded areas. It tends to ascend during periods of monetary easing. You can see that the yield curve tends to bottom or tends to be at a bottom or close to a bottom when these financial crises hit. We've had several banking crises in the past. There was the Penn Central in 1970, Franklin National in 1974, then Continental Illinois in 1984. I think Mexico in 1982 was basically a Citibank crisis at the time. They made a lot of loans to emerging markets, and Mexico was an unanticipated crisis. The S&L crisis, of course, was a major banking crisis, and the big one was the subprime mortgage meltdown back in the great financial crisis. So we've added SVB here, SVB as the latest financial crisis, as you can see. And if that's the one, then the yield curve is probably pretty close to the bottom in its inversion. And it does imply, based on previous experience, that once the crisis hits, the Fed stops raising interest rates and actually starts lowering interest rates. It's a little bit hard to imagine that they're going to be lowering interest rates, but I think the markets will be more than happy if at the FOMC meeting announcements coming Wednesday, they basically say that they did 25 and they're done for a while, or that they're simply done for a while without raising rates. And things are there's enough turmoil in the financial system that they want to hold off on where they go from here. Look, the reality is Fed Chair Powell's been saying over and over again that they want to raise interest rates to a restrictive level and then keep it there. Well, how do you define restrictive? Well, how about a banking crisis? That kind of does it for me. So I think, 4.75%, 5%, that's restrictive enough based on the feedback we're getting from the financial markets in terms of this banking crisis. We know certainly that this surge in interest rates has had an adverse impact on the banks. The Fed, by the way, in November came out with its financial stability report, and there's really no discussion about what the implications are of interest rate risk, of seeing rates go up 400 or 500 basis points. What impact does that have on not just the economy, but the financial system? There's no discussion of disintermediation, which is what happens when interest rates are more attractive in the money markets than they are at deposits. Well, you get disintermediation. People leave deposits and put it in the money markets. Now, because we don't have deposit ceilings anymore, the banks are free to raise their deposit rates to be competitive with the money markets. But that, of course, squeezes their profit margin and creates some issues. And of course, there's that negative, those big losses in the bond portfolio, which don't have an immediate impact if they're stashed away as held for maturity. But clearly, there's been some issues here with regards to the banking sector. We actually, I think this is this figure one is the official yield curve spread. By what I mean by official is that it is one of the components of the index of leading economic indicators, and it's the Treasury yield less the Fed funds rate. I think most of us tend to focus on the 10-year minus the 2-year because it's not as doesn't take as long for the Fed funds rate to change, and besides, it anticipates pretty accurately what the Fed funds rate is going to do. So we know that this has been even more inverted, and you can see from the history of this particular series, which is available weekly since 1976, it does have a tendency to invert. Before recessions, it did it here, did it there. Once again over in this area, here. It even got pretty close to that, but couldn't possibly been anticipating the pandemic. I think it was just anticipating that the Trump-China trade war might cause things to slow down. So we saw it coming down here. And now the question is, are we going to have a blue shade here to mark an official recession? And I'm not ready to move there yet. Look, I think I had a high enough probability of a recession to stick with it. I've been talking 60% chance of a soft landing and 40% chance of a recession. So I think that pretty well reflected my perception that everything is not hunky-dory and things can go wrong. But even notwithstanding this banking crisis, I'm still pretty comfortable with 60%, 40%, 60% soft landing. And the reason for that is I think we're still in a rolling recession environment. Housing's already kind of gone through the ringer in terms of its recession. The goods sector has gone through its recession. I think we still have commercial real estate up ahead here that's going to be in a recession for a while. But consumers continue to spend on services. Capital spending, I think, gets just capital spending, both public and private, gets boosted by all this government spending on infrastructure. And I think companies are going to continue to spend on onshoring. So count me still as in the soft landing camp. Now, the hard landing story, of course, is the banking crisis is just that started is just the tip of it, and there's going to be a lot more trouble. And we saw that in the fourth quarter. I know this is labeled Q1, but that's when it was reported. It's really for the fourth quarter is the senior loan officers. And you can see that they all said that they're tightening credit conditions. And you can only imagine, we can only imagine, and it makes sense that they will have continued to tighten credit conditions in the first quarter. This is, by the way, the same thing for commercial real estate. That's not looking very, very happy. Despite the fact that they said they were tightening lending standards in the fourth quarter, the data through March 8th shows that we're basically at a record high. We are at a record high on total loans at the banks. And this shows you the large banks and the small banks. And maybe the small banks are going to cut back their lending activity in such a way that a lot of small businesses get hurt and we get a recession out of that. I would point out, though, that even during the great financial crisis, small businesses weren't complaining about credit availability. Right now, they're complaining about inflation being their biggest #1 problem. So it's not clear that small businesses are as dependent on small banks as one would think. They seem to be able to figure out how to get credit one way or the other. But certainly, I'll admit, if the small banks decide not to lend, that's going to have an impact, and it could very well cause a recession, or it could cause a rolling recession among small businesses that just doesn't add up to an economy-wide recession. Meanwhile, again, interest rates have been coming down. We saw how quickly mortgage demand picks up in the face of a fairly slight drop in mortgage yields back in February. So that could certainly happen again. And there's a lot of pent-up demand for autos, and auto financing terms certainly have tightened up, but maybe they just eased off a little bit as well with this recent drop in the 2-year. Again, this is just another chart showing the financial crises versus the Fed funds rate, and typically Fed funds rate peaks when you get the crisis, as you can see, pretty consistently, right? And so that would suggest that the Fed is done. That doesn't necessarily imply the Fed has to raise lower rates, given that there's still an inflation problem, which I think is moderating, but it's taking a little bit of time. So I guess the big risk is still in deposits, but it's no longer insured versus uninsured, because I think the Fed more or less has come in and guaranteed depositors that they'll be whole. I just did that for SVB. It's hard to imagine that they say, no, we're not doing this for anybody else. But then again, there may not be a continuation of this crisis severe enough to really warrant them coming in. The Fed is pretty skillful at coming up with bank liquidity facilities that just by creating them reduces the anxiety, reduces the panic, and reduces the need for them in the first place, other than as an announcement effect, saying that the Fed has our back. Look, I think the Fed put is back. It's not back in the sense that they're directly trying to help the stock market, but they're indirectly helping the stock market to the extent that the Fed put is now available to the banks with regards to their deposits. This just shows the percentage of uninsured deposits, which I think is no longer as big a deal or issue as it was prior to the Fed setting up the bank liquidity facility. This shows you securities holding at all banks, and this is one of the areas of concern. Is the banks have been accumulating larger and larger unrealized losses on their bond portfolios, and you can see they have a lot of bonds. This is U.S. Treasury and agencies, and this is other securities. I'm not quite sure what's in there, but it's probably mostly fixed income. And by the FDIC's estimates, banks had $600 billion in unrealized losses at the end of last year. So why didn't everybody freak out at that point? Because the perception is, and correctly, is that most of them are held to maturity, and therefore don't have an immediate impact on the financial well-being of that particular bank. But it's all psychology. If if the word spreads that you've got your money deposited in an institution that has a huge loss on their balance sheet, maybe people will pile out. But I don't think people do their homework on the financial institutions that quickly. As long as they feel the government's guaranteeing it, they go there. And that may be one of the reasons for the instability that we get persistently coming out of the banking sector. The banking cycle seems to be driven by the fact that during good times, depositors forget that there could be bad times in the bank, and their deposits might not be insured. And the bankers assume that the good times are going to last, and with all this other people's money that they have access to, they can leverage up the returns for their banks and see their stock price go up. And this is basically the old discount rate. It's now called Federal Reserve Bank loans, and that got everybody spooked because it jumped up by 150 billion during the week of March 15th. I think that mostly reflected the problems in the SVB and First Republic. It seems as though it was the San Francisco Fed's discount window where most of that money got taken from. So that's it on the charts. Again, I'll give credit where credit is due. The yield curve in the past has anticipated financial crises. It's done it again. Inverted yield curves tend to be associated with coming to the tail end of monetary tightening, or at least with a peak in money market and bond yields. And it looks like it's done it again, anticipated that peak. As a matter of fact, back in October 18th of last year, I used that yield curve inversion to say, you know what, we must be getting pretty close to a peak in the bond yield. And I thought it would happen in November. It actually, I wrote this up on October 18th. It actually occurred on October 24th, was the peak bond yield at 4.25%. So the inverted yield curve certainly gave me good guidance in terms of that call. I also think, because I believe that the bond yield peaked on October 24th and that the Fed is almost done, if not done completely, I think that October 12th, we made a low in the S&P 500, and I don't think we're going to retest it. I know that that's become increasingly contrary, and some people would say delusional, but that's where I am. Now, what's missing so far in this narrative is a credit crunch and a recession. So I'll be watching the credit numbers. We'll see how they unfold. But as I said, interest rates have been coming down, and that'll help some of the more interest rate sensitive parts of the economy, which have been in a recession, particularly single family housing. So if it turns out that we don't get an economy-wide credit crunch after all, then it'll still be what I think is a rolling recession. If I'm wrong about that, and I start to see in the data that, or just anecdotally here, that deposits are pouring out of the intermediaries and credit conditions have tightened dramatically. You won't need me to tell you all that. It'll all be in the papers, and that will be a credit crunch, and that'll lead to a recession. And the stock market will certainly at least retest the October 12th low and probably go below that. So the Mike Wilsons of the world, who's had a good call, I'll give him credit. But he remains, as you know, quite bearish, as do other bears out there. Well, that scenario's looking more plausible right now. But as I started out saying, 60-40% is the probabilities I gave to a soft, hard landing. 60 soft, 40% hard. I think I've been realistic in acknowledging that a recession is a possible scenario, and I gave it 40%, which is pretty high. So again, I don't really feel a need to change it. I know Goldman's economists raised their numbers. I can't recall, but I think it was something like from 25 to 30%, whatever. But they were more optimistic on not going into recession. Now they're less so. Well, with all that, let's do some discussion here, indirectly at least, for a little Q&A. I got enough cues to keep us busy here, so why don't I do it in reverse here? Willem, do you think it is right that the bank term funding program and the discount window 2 now values collateral at par? Should the Fed not be a lender of last resort rather than a lender of first resort, and then only on a penalty terms? It's a good question, but look, I think the Fed has a lot of experience with creating these liquidity facilities, and their number one goal isn't to get it absolutely right in terms of who should and who shouldn't suffer in terms of those who screw up in the banking system. Rather, they completely focused this facility on getting the word out that they're going to make sure that depositors don't lose any money. As a matter of fact, the press release that announced this facility had this very long title, which basically said, folks, we're going to do everything we possibly can, including the following facilities, to protect all depositors. So I think they were pretty explicit what their game plan was to make sure that they were playing to that audience, and that audience would calm down and not feel like they had to pull their money out. So at this point, it's I mean, from a fairness perspective, I think it is kind of going a little far to provide loans based on par rather than on market value. But then again, the Fed wanted to communicate that they realize they are the lender of last resort, and financial stability has to be maintained. Isaac, do you have a sense of how many U.S. regional banks have a high percentage of uninsured deposits similar to SVB? I've seen some tables on it. I don't recollect the exact numbers, but I think there are plenty that are at least 50%, some 60, 70%. I think SVP and First Republic might have been at the near the top of the list. But look, the issue of insured versus uninsured wasn't an issue until it was made an issue by the SVP situation. Everybody was sitting there parking lots of money in deposits well in excess of 250,000. Now, I think Congress is starting to evaluate whether we need it to be 1 million. I mean, what's the difference? Well, 750,000, of course. But what I mean is, what's the difference between insuring 250,000 or 1 million? If in a crisis, you're forced to kind of concede the point and tell everybody that you're all going to be protected. And of course, they're saying it's not going to cost taxpayers a penny because they say they're just going to get the money from fees on the banks as part of the insurance fund. But of course, that's a cost to banking and can be passed on to bank depositors. Why does everyone ignore the elephant in the room? 94 trillion of total debt in this country. Every 1% cost is a lot of money. Yeah, that's a good point. I guess right now we've got lots of other concerns here, immediate concerns, wondering whether there are more shoes to drop in the banking sector. But you're right, valid point. Debt is a pernicious problem throughout our society, both domestic and global. I've sort of come to terms with the problem as basically generational theft. I'm not happy about it. I'm morally incensed about it. But what we're doing is we're stealing from our kids and our grandchildren. We're leaving them a lot of debt in order to, get us through these crises without a lot of pain, in order to allow us to retire and collect Social Security. We're really running these huge deficits, and these huge deficits increase the debt, and the debt is something that we're passing on to our kids. Previous generations, particularly the generations that still had that immigrant mentality, worked hard, real hard for their kids. They wanted to send their kids off to the best schools and get them educated, and that's pretty much what had happened. And then the kids came out of school and had children and decided, well, what the hell? Let's just borrow a lot of money and let the kids worry about it. So, the reality is we haven't really had to pay a price for it so far, in the sense that supply and demand just doesn't seem to drive bond yield. There seems to be much more inflation expectations, and how the Fed's going to deal with all that. Maybe there'll come a time in our lifetime before we pass on this debt problem where it'll even turn out to haunt us in our retirements, and suddenly the debt we accumulated will make it impossible to accumulate more one way or the other. But we're certainly not there at this point. Okay, another question here from Anonymous. In the old days, Reg Q, I remember Reg Q. I started at the Federal Reserve Bank in New York in the late 70s, early 80s, and my job was to sit in an office without a window and keep on top of the deposit flows related to Reg Q. And back in the mid 60s, there was a sort of mini slowdown when interest rates rose above Reg Q ceilings and money poured out in what was called disintermediation, almost caused a recession, but the Fed lowered interest rates, so we didn't have an official recession. But then in the late 60s, early 70s, it happened again. And the reaction to all that was to deregulate, to allow banks to raise their interest rates. That happened in the 1980s. And here we are still having these crises. So in the old days, Reg Q constraints drove bank disintermediation when market rates rose above deposit levels. These deposits all created recessions. These episodes, with over half the banking system funded by non-insurable deposits and market rates generally higher than bank deposits, why should we not expect another wave in disintermediation and recession? That's a good question, and that's probably the risk here. It's a risk to all of us. It's a risk to the economy. It's a risk to my forecast, is that if we do get a pile of disintermediation, people just piling out of deposits into money market funds, then the banks are not going to have the funds to make loans. And on the other hand, what we are seeing is the banks are being forced to raise their deposit rates, and that in turn means that they're being forced to raise their lending rates. So I think at this point, this is really the number one issue with regards to whether the financial crisis kind of reminded everybody that not all of their deposits are insured. And by the way, they're not even getting a good return relative to money markets. And so if a lot of people kind of bail out of deposits into money markets, we're going to have a disintermediation credit crunch recession. I mean, like everybody else, it's hard to get data on a daily basis. I'll be watching this on a weekly basis. We do have data weekly from the Fed on their loans by small and large banks, same for deposits, the entire balance sheet. And we'll be watching that very, very closely. But so far, what I've heard is scuttlebutt chatter is that there's been a significant amount of buying of regional banks by insiders. So they're not particularly concerned, apparently. And what I've heard just through the grapevine is that nobody's talking about a massive outflows of deposits. Quite the opposite. You're seeing kind of like churning around. Maybe some people saying, okay, let's spread our money over more deposits so that no more than 250,000 is in any of them. But that doesn't lead to disintermediation. I'll take one from Gus here. Ed, if you assume credit tightens in Europe due to Credit Suisse issue, do they slow down rate hikes in Europe? It's a good question. You know, last summer, everybody, including myself, thought that Europe could have a really hard landing because of the gas situation. That seems to have been resolved. And just as everybody piled into Europe, the ECB is doing what they said it was going to do, raise interest rates. And on top of all that, people are reminded that they have banks and they have banking crises. And, you know, in some ways, their banks may be weaker than our banks, at least the big ones. So I think at this point, the ECB is kind of sort of on track to continue to raise rates, but I think they're getting awfully close to terminal as well. I think their inflation seems to be more seems to be higher than it is over here. Ours seems to be coming down faster than theirs is, and that would allow them to you know, stop slamming on the brakes and maybe just tap on the brakes. But certainly makes me want to come back to the US of A for global investment. In other words, the idea of going global may be premature here given Europe's troubles. And by the way, the Chinese, I think at the end of last week, lowered their reserve requirements. So they're having a tough time getting their economy going. You would think that once they eliminated the lockdowns, their economy would absolutely be booming and they wouldn't need to lower reserve requirements, but that's what they did. So lots of interesting things to stay on top of. I hope you're enjoying not just our daily and weeklies, but also our daily quick takes. As we get news and we want to respond quickly to that, to get it to you, we'll use the quick takes. More in-depth analysis will continue to be in the dailies. We will be watching the commercial bank data very, very closely. But I think on Wednesday, the market could get a lift from a much less hawkish Fed. I think depending on what is said, I'll probably be writing something called Fed Hawk Down. So one of my accounts suggested that would be a clever thing to have as a title. So we'll see whether Powell turns out to be Fed Hawk Down or less hawkish anyways. I know it was hard to have a good week last week, but I hope this week's better for all of us. Thank you.